Hi, we're back. We're continuing on talking about long-term liabilities from Chapter 12. This is the 32B, so the second part of Class 32 if you're in Monday, Wednesday, Friday class, and this is 23B, the second part of Class 23 for the Tuesday, Thursday folks. And now we're continuing on with long-term liabilities, and we're going to start talking about bonds. So we already talked a little bit about bonds when we were going through the asset side of the balance sheet. We talked about bonds that you might invest in and it becomes an asset. Well, a company can issue bonds when they need money, and they issue the bonds and it's sort of like they're borrowing money out on the bond market. So let's talk about bonds as long-term liabilities. Large companies need large amounts of money to finance their operations. They may take out long-term loans from banks and/or issue bonds payable to the public to raise the money. Bonds payable are long-term debts issued to multiple lenders called bondholders, usually in increments of $1,000 per bond. By issuing bonds payable, companies can borrow millions of dollars from thousands of investors rather than depend on a loan from one single bank or lender. Each investor can buy a specified amount of the company's bonds. The face value is the amount a borrower must pay back to the bondholders on the maturity date. Face value is also called maturity value, principal amount, or par value. So, continuing talking about bonds, and remember, this time we're talking about them as a liability, so as if the company is issuing bonds or borrowing money using bonds. That's what makes it a liability. The maturity date is the date on which the borrower must pay the principal amount to the bondholders. The stated interest rate is the interest rate that determines the amount of cash interest the borrower pays and the investor receives each year. The stated rate is also called the face rate, the coupon rate, or the nominal rate. So every time a bond gets issued, it's going to be at a rate, right? So we're going to borrow in $1,000 increments usually, $1 million at a face rate of 6%. So if somebody bought those bonds, they would get paid 6% every year. This is a picture of what a bond might look like. So in this example, Smart Touch Learning is issuing a bond. And so a bond looks something like this. They're on fancy engraved paper. And they tell who issues them, and they'll have the amount, and they'll have the date that it matures, and they'll have the stated interest rate, and all the importance. It's a legal document, actually. It's their contract for the loan. That's what a bond is. It's a contract for a loan, but it's just that people sell it back and forth on a market. So this is what a bond would look like. So if you bought a bond, that's what it would look like. If you were issuing bonds, you're issuing these, and then people give you cash for that. So this becomes the liability to you, is you've issued a bond, and now that's a long-term liability. Types of bonds. All right, so let's talk about a few different kinds of bonds. If you take finance classes, you'll probably get into this in real detail. There are various types of bonds, including the following. Term bonds. These bonds all mature at the same time. For example, $100,000 of term bonds may all mature 5 years from today. So if a company issues term bonds, right, so they're going to have this long-term liability of bonds, they all come due at the same time, right? So they issue $100,000, and when the 5 years go by, they'll pay off that $100,000 all at once. Serial bonds. In a series, just like it sounds, serial bonds are in a series. These bonds mature in installments at regular intervals. For example, a $500,000 5-year serial bond may mature in $100,000 annual installments over a 5-year period. So you're going to get a series of bonds. You'll get the 1 year, 2 year, 3 year, 4 year, 5 year, and you'll each of those bonds would get paid off in their proper period. That's called a serial bond. Secured bonds. These bonds give the bondholder the right to take specified assets of the issuer if the issuer fails to pay principal or interest. So that's, like we talked about mortgages as being a note payable with some collateral, like a house or building. Well, a secured bond is a loan and there's collateral, maybe a building or something that secures the bonds. Debentures. These bonds are unsecured bonds that are not backed by assets. They are backed only by the creditworthiness of the bond issuer. Right? So debenture is an unsecured bond. It's got no asset backing it up. Let's talk a little bit about bond prices. This is where we start to get where you have to kind of concentrate a little bit. A bond can be issued at any price agreed on by the issuer and the bondholders. A bond can be issued in any of the following. Face value. Face value occurs when a bond is issued at face value. For example, a $1,000 bond issued for $1,000. The amount the borrower gets from the purchaser is the face value. Discount. A discount on bonds payable occurs when the issue price is less than the face value. So, for example, a $1,000 bond issued for $980. The discount is $20. Right? The difference between $1,000 and $980. So you have face value, $1,000 for $1,000. Discount, you're issuing it for something less than the face value. And a premium, like it sounds, a premium on bonds payable is when the issue price is above the face value. Example, a $1,000 bond issued for $1,015. The premium is $15. So face value equal to what the face value is, discount less than the face value, premium more than the face value. The issue price of a bond does not affect the required payment at maturity. In all of the preceding cases, the company must pay the face value of the bonds at the maturity date stated on the face of the bond. The issue price of a bond determines the amount of cash the company receives when it issues the bond. In all cases, the company must pay the bond's face value to retire it at the maturity date. So, it's easy to see that when you buy a bond at face value, you pay $1,000, you're going to get $1,000 back. However, interestingly, if you buy it at a discount, you only paid $980 for it, at the end, you're going to get $1,000 back. Alternatively, if you pay a premium for it, $1,015, at the end, you're only getting $1,000 back. So whatever it says on the bond is the face value. When that bond matures, what you get is the face value, regardless of how much was paid for that bond. All right, so here's an example. Example 12-4 shows example price information for the bonds of Smart Touch Learning. On this particular day, 12 of Smart Touch Learning's 9% bond maturing in 2021. So there you go, bonds, Smart Touch Learning, 9% of 21. So that's the name of the bonds. So bonds trade on exchanges, so you can just look them up and figure out what bond it is. How many? 12. High, low, close. So those are the prices during the day that you can trade your bond for. The bond's highest price on this day was $7.95. The lowest price of the day was $7.8450, and the closing price was $7.95. So once these bonds have been issued, people sell them amongst themselves, and they're going to have varying prices. All right, so that's a thing to keep in mind. Bond prices, once they're issued, people are going to exchange them amongst themselves, and the prices go up and down. All right. This concept of present value, super, super important. If you finance majors don't already know this, get on top of this. This is your first chance to learn it. Money earns interest over time. So we've kind of gotten that down, right? We know principal times rate times time equals interest. A fact called the time value of money. The time value of money is the recognition that money earns interest over time. The present value is the amount a person would invest now to receive a greater amount in the future. So think about bonds. They don't mature until 10, 15, 20, even 30 years, right? So how much, if I know I'm only going to get $1,000 in 2021, let's go back and look at this. Right, if I know that in 2021 I'm going to get $1,000, right? Now every year I'm going to get some interest, but if I'm only going to get $1,000, but I'm not getting it for quite a few years, I probably am not willing to give you $1,000 today for $1,000 tomorrow, right? That doesn't make sense. So I can use my money today and get value from it. If I'm going to let you use it, I want something in exchange. I want some interest, and I want to make more money out in the future than I'm giving you today. So that's why we have these different prices for bonds, because, well, money is worth something, right? The time value of money. So if I don't have it today, I can't use it, I can't invest it, I can't make my interest. So that's what this is all about. So especially important for bonds because they do take a while to mature. So let's talk about bond interest rates. All right, so let's talk about bonds and this time value of money idea, present value. Bonds are sold at their market price, the issue price on the day the bonds are first sold. So when the company first issues the bond, that's called their market price, which is the present value of the interest payments the bondholder will receive while holding the bond, plus the present value of the bond principal paid at the end. Two interest rates work together to set the price of a bond. The stated interest rate determines the amount of cash interest the borrower pays each year, right? The stated interest rate is printed on the bond and does not change from year to year. The dollar amount of interest paid is not affected by the issue price of the bond. So once that bond is issued at 5%, 8%, 9%, every year the issuer has to pay that rate, no matter what interest rates do in the meantime. All right, so you got that steady interest getting paid out to the bond holder. The market interest rate, also known as the effective interest rate, is the rate that investors demand to earn for loaning their money. The market interest rate varies constantly. A company may issue bonds with a stated rate that differs from the market interest rate due to the time gap between the time the bonds were printed, showing the stated rate, and the actual issuance of the bond. Exhibit 12-5 on page 604 shows how the stated interest rate and the market interest rate work together to determine the price of a bond. So if you think about this, the bond stated rate is one thing, and its actual market rate is another thing, right? So when they're equal, when the stated rate and the market rate are equal, you're going to issue the bond at the face value because everything's equal. However, if the market rate goes up and the face value, the face rate is lower than the market rate, well, people don't want that because they can go get 10% instead of 9% right now. Why would I buy your 9% when the rate right now is 10? So what you can do is, well, yeah, but still go ahead and buy these bonds. We're going to discount them, right, to make it to where what you get is the equivalent of that rate. Or if rates drop, then that means, hey, this bond with 9%, that's a little better than a bond with 8%. So I wanted to pay more than the face rate for that. So that's how bond interest rates affect the issuing price of the bond. You're going to get a discount or a premium if the interest rate has gone up or down. All right. Issuing bonds versus issuing stock. All right. So borrowing by issuing bonds payable carries a risk, right? The company may be unable to pay off the bonds and the related interest. Why do companies borrow instead of issuing stock? Debt is a less expensive source of capital than stock. and bonds do not affect the percentage of ownership of the company. Companies face the following decision. How shall we finance a new project, with bonds or stock? Financial leverage occurs when a company earns more income on borrowed money than the related interest expense. All right, so we aren't going to really get too much into this idea of leverage. However, borrowing money increases your ability to earn money, as long as what you're earning is more than what you're paying out in interest. And so you want to do that. Plus, a lot of places don't want to dilute the ownership. So if they just borrow money from lenders, then the owners are still the ones who own the company. By issuing more stock, you're getting more owners into a company, and a lot of places don't want to do that. All right. So issuing bonds versus issuing stock. So here's an idea of, should we issue bonds or should we issue stock? Smart Touch Learnings Management believes the new cash can be used to increase income before interest and taxes by $200,000 each year. The company estimates income tax expense to be 40%. Exhibit 12-6 on page 605 shows the advantage of borrowing as it relates to earnings per share. So as you can see, when you borrow the money, you're going to get $3.90 per share, whereas if you issue stock and you dilute the stock ownership, you're going to, and plus you don't get the advantage of deductible interest, you're only going to be increasing your per share earnings by $2.80. So a $1.10 difference in increases in earnings because of that leverage idea. So, you know, companies go through this. Whenever they decide, well, should we issue more stock? Should we borrow money using bonds? They sit down and think about, well, how will this affect earnings per share? Should we do it or not do it? Which way should we, how should we pay for our operations, and how should we pay for our new machines and things like that? So borrowing goes on versus issuing stock. And so for purposes of this class, for this next exam, we're thinking about bonds, and we are going to talk about equity next. So right now, chapter 12, we're talking about long-term liabilities, which are mortgages, bonds, long-term notes. All right, so that's going to end class 32 for the Monday, Wednesday, Friday folks. For Tuesday, Thursday folks, we're going to continue on with class 23, so there'll be another video 23C. And for Monday, Wednesday, Friday folks, your next class 33 is coming up. All right, have a great day. See you soon.